Let me ask you something. How many people do you think actually read tax legislation? How many crypto holders even know the name of the bills sitting in Congress right now that are about to determine how much of their gains they actually get to keep? I am going to bet the answer is almost nobody. And that gap between what is written in law and what regular holders understand is where a lot of wealth gets quietly transferred away from the people who earned it and toward the people who read the fine print. So today, we are reading the fine print together. 3 bills, 3 completely different problems being solved, and together they form something that has never existed in this country before, a complete legal and tax framework for digital assets built from the ground up. Most people are watching one. Most people do not even know the other 2 exist. By the end of this video, you are going to know all 3, what they actually do and what it means for your wallet specifically. Let us start with the one that is already done and that almost nobody noticed when it happened. On July 18, 2025, President Trump signed the Genius Act into law. Not proposed, not pending, not coming soon, signed into law. The Guiding and Establishing National Innovation for U.S. Stablecoins Act became the first major federal cryptocurrency legislation in United States history. It passed the Senate 68-30. It passed the House 308-122. Those are large bipartisan majorities by any measure, and yet it landed with almost no coverage in the communities that should care most about it. So what does the Genius Act actually do, and why does it matter for you? The Genius Act governs stablecoins. For anyone who needs the plain language version, a stablecoin is a digital asset pegged to the value of a regular currency, in most cases the US dollar. 1 token equals $1. It does not go up or down. It holds its value. Its entire purpose is to move dollars across a blockchain without the price volatility that comes with assets like Bitcoin or XRP. You have probably heard of USDT and USDC. If you follow Ripple, you've heard of RLUSD, Ripple's own dollar-backed stablecoin. All of these are now operating under the first federal law ever written specifically for this technology. What does the Genius Act require? Every stablecoin issuer operating in the United States must maintain full one-to-one backing. For every digital dollar issued, there must be a real dollar sitting somewhere to back it. No fractional reserves, no creative accounting, $1 in and $1 out. Issuers must submit monthly financial reports, pass regular audits, and comply with the same anti-money laundering standards that traditional banks follow. The regulations to implement the Genius Act are required from federal agencies no later than July 18th of this year, meaning the full operational framework is being built right now in real time. Here's why this matters to you specifically. Before this law existed, stablecoins operated in a gray area. Institutions that wanted to use them for serious financial infrastructure could not get their legal teams to sign off. The liability was too unclear. The Genius Act removed that ambiguity permanently. It made stablecoins an officially recognized payment mechanism in the United States with a clear legal framework that institutions can work within. And here's the connection that most people completely miss. RLUSD, Ripple's stablecoin, is now operating inside a legal framework that gives every institution considering it a clear written answer to the question their compliance department was asking. Is this legitimate? Is it regulated? Can we use it without legal exposure? The answer is now yes, in writing, signed by the president. So when you hear about RLUSD and XRP working together as an ecosystem, meaning the stablecoin as the on-ramp and XRP as the bridge asset, understand that the on-ramp now has federal legal status. That is not a minor detail. That is the foundation the entire system sits on. Most people scrolled right past that headline in July of last year. Now you know what they missed. Now let us talk about the Clarity Act, and I want to be specific about what most people get wrong here, because this misconception could cost you clarity at the exact moment you need it most. Most people think the Clarity Act is the beginning of XRP's legal protection. It is not. The SEC already named XRP as a digital commodity. The court case happened, XRP won. That was the verdict. But here's what most people do not realize. A regulatory determination can be reversed. New administration, new SEC chair, someone decides to revisit the classification, and without legislation backing it up, the determination is only as permanent as whoever sits in the next regulatory seat. The Clarity Act writes the verdict into law. It makes it untouchable by future administrations. It converts regulatory guidance into statutory protection that cannot be undone without an act of Congress. That is not permission. That is lock. And that is what we are waiting for. Now, here's why it feels like it's taking forever, and why most people have never had this explained clearly. The bill has to pass through two separate Senate committees before it even gets to a full floor vote. The Banking Committee and the Agriculture Committee both produced their own versions. Both versions had to be reconciled into one unified bill. Then it needs 60 votes on the Senate floor. That's one of the most complex legislative paths any bill can travel, and it's still moving. The biggest sticking point, the stablecoin yield dispute between banks and crypto firms, reached an agreement in principle in late March of 2026. Senators Tom Tillis and Angelo Alsobrooks negotiated compromise language. The Senate Banking Committee markup is targeted for the second half of April of this year. Galaxy Digital's Alex Thorne has stated that if the bill does not clear committee by end of April, it's likely done for 2026 because midterm election dynamics take over the Senate calendar. Coinbase's own chief legal officer went on national television and said a deal is very close. The White House is pushing in the same direction. If the Clarity Act passes, what you are holding stops being protected by a regulatory determination and starts being protected by statute. And that single shift from guidance to law is what unlocks the institutional capital that has been sitting on the sidelines waiting for exactly this moment.
Now, there is a third bill that almost nobody is talking about, and this is the one that hits your wallet the most directly. It is called the Parity Act, and if you have been earning staking rewards, doing year-end tax loss harvesting, or using stablecoins for any kind of transaction, this legislation changes your entire financial picture. Here is the problem the Parity Act is solving. Right now, in the United States, every single crypto transaction is technically a taxable event. Every single one. If you buy a bag of chips with a stablecoin, that is a taxable event. If you swap one token for another, that is a taxable event. If you receive staking rewards, that is taxable income the moment it hits your wallet. Not when you sell, not when you convert to cash, the moment you receive it. Even if those rewards drop in value the next day, even if you cannot sell them, even if you never converted anything to dollars, you already owe taxes. The crypto community has been calling this phantom income for years. You receive something, you owe tax on it, but you do not have the cash to pay the tax because you never touched dollars. The Parity Act was introduced on December 20th of 2025 by Republican Representative Max Miller of Ohio and Democratic Representative Stephen Horsford of Nevada, both members of the House Ways and Means Committee, bipartisan from the first day. Here are its three specific changes, and I want to walk through each one clearly because all three of them matter directly to your financial life. Change number 1. Transactions under $200 using regulated stablecoins will not trigger a capital gains tax event. If you use RUSD or USDC to pay for something under $200, there is no tax calculation required and no cost basis tracking needed. No reporting obligation. It gets treated the way small foreign currency transactions are treated. You exchange value, it was small, you just move on. This is enormous for adoption. One of the biggest invisible barriers to crypto being used as actual money in everyday transactions has been this tax friction. Every payment requiring a tax calculation makes crypto impractical for real-world use. This provision removes that barrier entirely for regulated stablecoins. And importantly, to qualify, the stablecoin must be issued by a Genius Act permitted issuer, which is exactly why the Genius Act we just covered matters so much to the Parity Act. The two bills are designed to work together. Change number 2. Staking and mining rewards can be deferred for up to 5 years or until you sell, whichever comes first. This eliminates phantom income. You receive staking rewards. You do not owe taxes on them the day they hit your wallet anymore. You owe taxes when you actually sell them and have the money in hand. For anyone running a staking operation, participating in yield on digital assets, or earning validator rewards, this changes the entire math of the activity. The difference between paying taxes on income you cannot access versus paying taxes when you actually realize the cash is not a small detail. For large staking operations, it is potentially the difference between the activity being financially viable or not. Change number 3. Wash sale rules come to crypto. Now, I want to be straight with you about this one because it is a genuine give and take, and you need to understand both sides. Right now, crypto has a loophole that stocks do not have. If you sell crypto at a loss, you can claim that loss as a tax deduction and immediately buy the same asset back. No waiting period. Stocks cannot do this. There is a 30-day waiting period called the wash sale rule, but crypto has been classified as property, not a security, so that rule never applied. The Parity Act closes that loophole. If you sell crypto at a loss and want to claim that deduction, you now have to wait 30 days before buying the same asset back. Here's how to think about this honestly. The loophole closing is the trade the government needs in order to give you the staking deferral and the stablecoin exemption. You cannot get the benefits without giving something back. Aligning crypto with the same rules stocks follow is also part of what makes this space legitimate in the eyes of institutional investors. The bill currently has bipartisan support, and its sponsor believes it can advance before August of 2026. Now, let me bring all three of these together because this is where the picture becomes very clear. The Genius Act built the legal foundation for stablecoins. That's done. It's law. It's operational right now, and implementing regulations are being written by federal agencies as you read this. The Clarity Act is locking in the legal identity of digital commodities and opening the door for everything institutional that gets built next. That is moving with a late April Senate markup target. And the Parity Act is fixing the tax code so that holding, using, and earning yield on digital assets works the way it should for regular people. That is moving with bipartisan support. 3 bills, 3 completely different problems, and none of them are getting the same conversation. Together, what they form is something that never existed in this country, a complete legal and tax framework for digital assets from the ground up. The Genius Act says these are legal payment instruments backed by real dollars. The Clarity Act says these specific digital assets are commodities protected by federal law. The Parity Act says you can actually use these things and earn from them without the IRS treating every microtransaction as a tax calculation. Most people are waiting for one checkbox, the Clarity Act to pass, the price to move, the legislation to get signed. But the system being built around what you're holding is not one checkbox. It's 3 separate legislative tracks moving simultaneously. The foundation is already law. The market structure protection is in its final legislative weeks. The tax framework is coming right behind it. Here's the thing I need to close with that the transcript put beautifully, and I want to make sure lands with full force. The Parity Act is specifically about small stablecoin transactions and staking deferral. It does not touch what happens when your digital assets appreciate significantly and you sell. Those gains are still fully taxable. Every dollar of profit you make on assets like XRP or XLM or HBAR in a regular account, the IRS is still your silent partner whether you invited them in or not. That's where the structure of your holdings matters as much as what you hold. Tax-advantaged accounts where gains can grow without a capital gains event sitting on top of every move. Not deferred like the Parity Act staking provision, actually free. The Clarity Act protects the asset. The Parity Act reduces friction on using it. But for the big move, the structural conversation is where you hold it and under what tax framework. Understanding the legislation being built around this space gives you power, not because knowing the bills changes the price, but because knowing what's coming lets you structure your position to actually keep what you earn. If this video gave you information that most crypto holders genuinely do not have yet, hit the like button right now. It's genuinely how this reaches the people who need to make these decisions before the legislation passes and not after. Subscribe if you want every major regulatory development broken down in plain language the moment it matters, because this 3-bill framework is moving faster than most people realize, and the gap between informed and uninformed holders is measured in real money. Drop in the comments, genius, clarity, or parody. Which one surprised you most? Let that conversation run, and if you know someone who thinks all they're waiting for is the Clarity Act to pass, send them this video, because they're missing 2/3 of the picture. Stay wise, stay wealthy, do the work.